Welcome back, everyone, to another insightful episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into a topic that intrigues many traders but can also seem daunting: options trading simplified. Key concepts and mistakes to avoid as a beginner. Now, options trading can seem overwhelming at first glance, filled with terms like delta, gamma, theta, and vega, but when properly understood, options can significantly enhance your investment portfolio by managing risk and amplifying returns. Unfortunately, many new traders jump into the options market without grasping the fundamentals, leading to unnecessary losses. So today we're breaking down everything you need to know clearly and simply, while highlighting the common pitfalls to steer clear of. Let's start with the basics. What exactly are options? An option is essentially a financial contract giving you the right, but not the obligation, to buy or sell an asset at a set price, known as the strike price, before a specific expiration date. There are two primary types: call options and put options. If you anticipate the price of an asset will rise, you'd buy a call option, securing the right to purchase at today's price. Conversely, if you believe the price will drop, you'd buy a put option, granting you the right to sell at the predetermined strike price. To put it into perspective, imagine a stock is currently priced at $100 and you buy a call option with a strike price of $105. You're essentially betting that before expiration, the stock will rise above $105. If it does, you profit from the difference minus the premium paid. If not, your loss is limited to the premium itself. Now, let's talk about the Greeks, which are crucial in understanding option prices and risks. These metrics, delta, gamma, theta, vega, and rho, help you measure how various factors like price movements, time decay, and volatility will impact your trade. Delta measures sensitivity to price changes. For example, a delta of zero point 0.6 implies the option price will move 60 cents for every $1 movement in the underlying stock. Gamma is the rate of change of delta as the underlying price moves, helping traders understand potential changes in sensitivity. Theta represents the inevitable time decay of an option's value. As expiration nears, the option loses value if other factors remain constant, making theta crucial, especially for short-term options. Vega measures sensitivity to volatility, meaning how much the options price will change with fluctuations in the market's expectations of volatility. Higher volatility typically means higher premiums. Lastly, rho reflects sensitivity to changes in interest rates, usually less impactful than the others, but still worth understanding for longer-term options. Understanding these Greeks helps traders avoid emotional decision-making and provides a structured approach to options trading. However, many beginners make mistakes by neglecting these vital metrics. So, what are the most common pitfalls new options traders fall into? First, there's the classic mistake of gambling on short-term, inexpensive options, treating them as lottery tickets. These short-dated options can offer tempting payouts, but often end up worthless due to rapid time decay. As a beginner, you're better off focusing on longer-term options, like long-term equity anticipation securities, LEAPs, or using strategies not reliant solely on aggressive price movements. Another significant mistake beginners make is ignoring the Greeks altogether. Without accounting for theta, traders may hold options too long, unaware that time is steadily eroding their value. Without understanding vega, traders might buy options when implied volatility is high, causing premiums to deflate even if the underlying stock moves in the expected direction. Over-leveraging is another frequent error. Options inherently provide leverage, allowing traders to control substantial positions with relatively small capital. While leverage amplifies gains, it equally magnifies losses. Beginners often get caught up purchasing large quantities of out-of-the-money, OTM, options, which offer lower probabilities of profitability. Instead, a disciplined approach using limited risk strategies like vertical spreads can help manage risk effectively. Many novices also enter options trades without an exit plan, leading to emotional and impulsive decisions. Establishing clear stop-loss and take-profit levels before executing a trade ensures disciplined risk management and protects your capital. Neglecting implied volatility, 4, is yet another pitfall. 4 represents the market's forecast of future price movements. High 4 makes options premiums more expensive. Beginners frequently buy options without considering 4, only to witness premium erosion when volatility subsides, regardless of correct market direction predictions. Assessing 4 before trade entry can help avoid unnecessary losses. Diversifying strategies is also critical. Many beginners fixate on simply buying calls and puts, overlooking more reliable strategies such as credit spreads, iron condors, and covered calls. These strategies involve selling options alongside buying them, thereby limiting risks and increasing probabilities of success. With these pitfalls in mind, how can beginners safely approach options trading? Firstly, paper trading is invaluable. Simulated trading accounts allow you to practice without risking actual capital, enabling you to learn the mechanics and strategies comfortably. Secondly, focus on defined risk strategies. Spreads, for example, clearly define maximum losses, protecting your capital and allowing for steady portfolio growth. Third, always manage your position size. Never risk more than a small percentage of your total account on any single trade. Many professionals recommend risking no more than 1 to 2% per trade. Monitoring earnings reports, news events, and market conditions is equally vital. Significant announcements can cause rapid and unpredictable price movements, impacting your options dramatically. Staying informed helps you anticipate and adjust accordingly. Finally, commit to continuous learning. Markets evolve, strategies improve, and remaining educated ensures you're adapting and refining your approach. To summarize, while options trading can indeed be powerful, beginners must approach it carefully, armed with solid foundational knowledge, discipline, and risk management practices. Understanding the core concepts, such as the Greeks, implied volatility, and proper use of leverage, while avoiding common beginner errors significantly increases your chances of long-term success. If you're ready to start or further enhance your options trading journey, consider exploring crystalballmarkets.com. Their platform offers robust tools, educational resources, and clear risk management frameworks tailored to help retail traders navigate the complexities of options trading effectively. Thank you so much for tuning into Financial Market Insights for Traders. I'm Sophia, reminding you that informed trading is smart trading. Until next time, trade safely, trade wisely, and keep learning. Happy trading!